On today's episode, we talk imports with our Director of International Procurement and Recyclables. Plus, Nick tells us what to make of recent bank closures. Grab a cup of joe, it all starts now.
Hello, everyone. Welcome to Cup of Joe. I'm your host, Mike Carrazzo, and joining us, as always, is Nick Webb, our Director of Risk Management, Commodities Hedging, and I have nothing to say. Just
hey, Nick. Howdy. How you doing today?
Howdy, partner. Looking good. Yeah, we're so you're coming remote. Where are you at?
I'm coming remote from a Ryerson location in Salt Lake City. After that little jingle with this hat on, I feel like I need a guitar.
Yeah, you got some Spurs.
Absolutely.
Well, yeah, looking good.
Hey, appreciate that.
And as we alluded to in the theme song, we have a guest with us today, Jeff Penz, a returning. I think you're the very first returning guest, if I'm not mistaken.
I'm honored. After 5 times, I get a jacket like SNL, right?
Yes.
Or a cowboy hat.
Joined us not last year, maybe the year prior, to talk imports, and a lot going on with that today. So now, we thought it'd be a great time to bring you back. And Nick, a lot of things going on in the marketplace. Some big news with banks closures since our last episode. So you're going to dive into all that. But before we do that, I'd like to get into a little housekeeping here. It's coming up here. We promoted it last month, and here in a few weeks, we're going to be doing Metal 102. It's the sequel to Metal 101, which we did last October, where our product managers gave us the inside scoop on all the basics of carbon, stainless, and aluminum. This time around, we're going to be talking fabrication, defining simple terms, some processes, some machines. We have our Ryerson Advanced Processing folks leading that. That's surely to be an exciting 60-minute webinar with live Q&A. If you register and you can't make it live, you can see it on recording. And we just dropped the registration link in the chat. So if you get a chance down there at the bottom to register, you won't want to miss this one for sure. So without further ado, right next to that chat button is the Q&A button. So if you have questions for Tex along the way, put them down in the Q&A, and we'll try to get to those as we go along. So without further ado, giddy up, little partner.
Giddy up. Let's get into it. Before we get into that, always have to cover the safe harbor provision. These are the opinions of Nick Webb, Jeff Penz, Mike Carrazzo. They are not the opinions of Ryerson. This is not investment advice. Do your own research and all that. But we got some pretty interesting information to share here today. We actually have a lot that we have to get through. So I'll go somewhat quickly through the first couple slides. Definitely want to spend a few minutes on what's going on within the financial sector, because just a couple days after we hopped off our last Cup of Joe, I think I may have jinxed things, because in the last Cup of Joe, the general theme was marching higher for longer. And that was mostly in context of the Federal Reserve and interest rates, and how they were continuing to take rates higher and higher. Well, something happened, and we'll dive into some detail on what exactly happened and what maybe has changed in the last 30 days. But let's go ahead and get into it. So starting off on the macroeconomic side of things, it's an extremely mixed bag. The first thing I want to touch on, for obvious reasons, is going to be the United States. Down near the bottom of this slide, 3 from the bottom, we've got the United States, and we continue to be in contractionary territory. It's not sky is falling, but it's below 50. You can see 49.2 per market. So this isn't ISM, this is market. And we've been in negative territory or contractionary territory for the better part of 5 months. So a little bit of a slowdown, some headwinds. Again, certainly not sky is falling. But contrasting some of that, you can see as we look in the middle section over on the right-hand side, again, this is alphabetical order, left to right, looking over the last 12 months. This is purchasing managers indices for anybody who's new to the presentation. Anything above 50 is suggestive of year-over-year growth. Anything below 50 is year-over-year weakness. And when we look at some of these regions like India, India is running incredibly hot, which goes against a lot of the other themes we're seeing in many other regions of the world. So, as we sit here today, India's, about 4 trillion in GDP. So certainly not small potatoes. They're not to the extent of a China or the United States, but that's a big economy. And their forecasted growth rate for this year is around 6.5%. So they're really bucking the global trend, still running hot for the better part of, I'd say, 8 to 9 months. You can see those PMIs up in the mid 50s. And I don't know what it is about the alphabet. For some reason, the middle of the alphabet seems to be doing a bit better on a relative basis than other regions of the world. The other one I really want to point out is China. We talked last month about how China, for the better part of 2.5, 3 years, was in a pretty stringent lockdown. And it's looked like over the last couple months, they're beginning to emerge out of that. Well, in the last 30 days or so, at least per the PMI data, the manufacturing data, we are seeing a little bit of headwinds to that recovery. So maybe some of the hype, some of the elation around their return to getting back to normal, getting back to traveling and manufacturing things, maybe we need to kind of temper our expectations a little bit. Maybe this is going to be more of a Q2 story or potentially a second half story, because you can see the PMIs, they're still in growth territory, but they've eased back to almost flat. And then I know I'll probably get a question on this, but because I tend to always, when I cover this chart, I do want to touch on Russia. Russia for about 7 or 8 months has been in, at least per PMI data, in growth territory. And the reason why I say per PMI data is purchasing managers indexes, they are a survey. Is it possible that they could be manipulated or tweaked to fit some narrative? It's possible. As we look at this data right now, it is growthy. We've talked in prior Cup of Joes about the possibility that a lot of different regions, particularly India and China, are continuing to buy commodities from that region. That could be helping to keep them somewhat afloat. Now, we have to caveat all this, and I'll touch on this very, very briefly, but it is worth noting that in the last 10 days, there was a Wall Street Journal journalist who was actually stationed in Russia, and they wrote an article basically saying that things are actually worse in the country than what's being reported or what he had believed it to be. It got published while he was in Russia, and he's now he's a prisoner, for lack of a better phrase. So I don't know if he was reporting on the actual truth, and maybe this PMI data is actually weaker than what the PMIs are suggesting. But I wanted to at least touch on that because it is potentially an asterisk that we have to note.
Hey, Nick, real quick on here, I'm going to stop you early. If I look at the United States, so if you look at the past few months, right, 49, 47, we kind of went from 46, it's generally moving upward, right? I mean, it's not above 50, but it's moving upward. You look conversely at something like Russia, and it's starting to move down. In a way, could it be taken positively that we are kind of incrementally ticking up? I guess it's not a bad narrative.
Yeah, I mean, basically what you're saying is the rate of slowing is getting better. So the pace of the decline has slowed. I think there could be some truth to that. There could be a little bit of a seasonal factor. Granted, this is looking at year-over-year data, so the seasonal factor should be mostly teased out. But it is the case, at least here at Ryerson, when we look across I think we've got 40 or 50,000 customers. We are seeing some that are, really seeing a lot of strength in both Q1 and they're seeing that continue into Q2 and even Q3. So there is some relative strength sitting out in the market. Now it's sector by sector. But yeah, I think that observation is an accurate one. I do want to caveat that though, is this is market data. When we bounce that off of the ISM, which is the Institute of Supply Management data, the ISM data did unfortunately go the opposite way. So that can happen on a month-to-month basis. These two can diverge. I don't have a great explanation as to why one person would fill out a survey, another person would fill out a survey a different way. But for whatever reason, ISM and the way that they tabulate their survey data is actually showing a slightly different situation, which is manufacturing activity is not only slowing, the pace of that slowing is actually getting a little worse in their eyes. And then when we look at the subcomponents, and I've kind of circled this and highlighted this, I don't want to signal sky is falling, but I do want to at least note the notion that for the first time since 2009, every subcategory of the ISM, as you can see this list that's circled, is now below 50. It's not drastically below 50, but it is below 50 for the first time since 2009, which for those who weren't in the economy or post, I guess in the workforce, that would have been tied around the great financial crisis. I'm not at all suggesting that we are seeing a repeat of that, but it is certainly something that's suggesting that on a fairly widespread basis in the manufacturing sector, headwinds are afoot, I would say. Now, that's not to say that all the news in the economy or the macroeconomy is bad news. There's a lot to be excited about. And I touched on that, within our own customer base, we're certainly seeing pockets of pretty extreme strength. On the whole, I would say things are good. They're good, okay, nothing great, but certainly not sky is falling at this point in time. When we look at the employment situation, employment is still sitting at the employment rate is still sitting down near multi-decade levels. The recent data points were the lowest in history, I believe, at 3.4%. We're currently sitting at 3.6%. On a historical basis, that's extremely tight. Labor markets are very tight on a historical basis. When we look at wages, fortunately, despite the fact that we have high inflation, wages have moved somewhat commensurately with inflation. So what that means is, while it's more painful and it stinks to pay, an extra 30, 40% for products when you go to the grocery store, the good news is for those who have jobs, which is pretty aplenty right now, they are getting paid incrementally more and more money on a year-over-year basis. Right now, that's sitting at about 6%, which perhaps not coincidentally is right around where inflation rates currently are. So that's the good news. Now, that's the good news from my vantage point. From the Federal Reserve's vantage point, they look at this and they probably scoff because usually wages tend to be sticky. They tend to be, unless you lose your job, you tend not to have your income cut. Another bit of good news, I touched on this on the PMI slide, but mobility data within China certainly is improving. It's not all the way back to pre-COVID levels, but what we're looking at here, this is pretty high frequency data looking at daily passenger rides on the Beijing metro system. So you can almost read into this as how many people are getting on a train to go into work, get moving around, hopefully go shopping, spend money, get their economy back on track. And you can see that it's currently sitting it's trending right around its highest levels in a couple of years. So that's a bit of good news there. I will say again, within things like, it's interesting, Macau, which is a big gambling center of China, a lot of the, I think it was Wynn and Sands, a lot of these companies have come out and said that business is up like 250% year over year. So there are certain activities that mainland China is really getting back to normal in a very quick way. I think there are some other things that are a little more infrastructure oriented that haven't really taken hold yet. A lot of the stimulus money hasn't yet flown into some of the hard dollar, hard asset type things like infrastructure, real estate. There is hope. There's an expectation that is still going to come. But some of the quicker things like travel, leisure, getting back to work, those mobility trends do look like they're improving. Another bit of good news, we have, in the case of left, crude oil. So that's WTI crude oil prices. The right-hand side is going to be natural gas prices in Henry Hub, Texas. Both of these indices have, as you can see in the charts, have come off rapidly and substantially. So that should be good news for those who are manufacturing things. It's maybe not the greatest news for markets within Texas, where the economy has a fairly large chunk of its business and revenues that are tied to these two. But for everybody else in the world, lower energy prices makes it easier and cheaper to manufacture product and to transport it. I do want to note, though, on the left-hand side, crude oil, it doesn't look like a lot, but I'd say 2-3 weeks ago, the price of crude oil got down in the mid 60s, which was about half of where we were in June of last year. In the last 2 weeks, the price has risen by about 20%. And again, it doesn't look like a whole lot within this chart, but what's happened is in the last week, And I think it's fairly notable, not just from an energy standpoint, but also potentially from a geopolitical standpoint. OPEC plus, which would be, many of the oil producing regions of the Middle East, including Russia, they announced a surprise crude oil cut. And the cut amounted to, or will amount to, it's right around 1.2 million barrels per day for the balance of the year. And if you recall, last year, the United States drained its strategic petroleum reserve to the tune of about 1 million barrels per day for half a year. So call it 180 million barrels. This is basically flying in the exact opposite face of that. So I'm not trying to stir the pot on, geopolitical tensions rising, but it certainly looks like it could be something. At the very least, it does go in contrast to what the U.S. has been doing, which is draining its reserve to bring prices down. OPEC plus cutting production would, all things being equal, as long as demand remains constant, bring prices back up. So that not only goes in the face of what the SPR, the Strategic Petroleum Reserve releases were trying to accomplish. In a way, it also goes against what Jay Powell and the Fed is trying to accomplish, which is bring down inflation. So this will be something I think we want to keep an eye on, because if those cuts do in fact take place and they stay in place for the balance of the year, if you contrast that with the potential that China maybe is continuing to get back to normal, we could see tightness in the energy markets as we look into the summer months and in the back half of the year. So certainly want to keep an eye out on that space. And the last bit of good news, at least as we sit here today, it does look like inflation is coming back down. The blue line is going to be your headline inflation. The white line is going to be what they call core inflation, which excludes energy and food, but both of them generally are trending in the same direction. Perhaps you could make the argument that the headline inflation, which includes food and energy, is coming down at a faster rate. And maybe there's an argument to be made that core inflation is a little more sticky, perhaps because of things like wages, shelter being a little more sticky. But nonetheless, I think this is incrementally good news. There's a hope within the market, and certainly at the Fed, that this trend will continue. So what's the bad news, or what's this thing that Nick's been warning us about within the financial sector? Well, the issue is we still have inflation sitting up around 6%, and the Fed's goal, their stated goal, is to have something closer to about 2 to 3%. So their job's not done with regards to hiking interest rates. So the unfortunate thing is, this rate increasing cycle, which we've seen over the last 12 to 15 months, which has been the fastest in history, taking us from about 0% all the way up to today, 5% interest rates. It looks like the Fed's job is not done to really bring inflation down to where their target is. Now, I've got this quote up there in the top left corner, hike until something breaks. It's, maybe a little tongue in cheek in throwing that quote out there, that saying out there. I was talking to my analyst a couple weeks ago, and he was like, what do you mean something breaks? What does that actually look like? Well, we, on about 2 days after our last cup of Joe, we saw what something breaking looks like. In fact, we saw it a couple times. And again, I don't want to tell everybody to make a run on your bank. This isn't It's a Wonderful Life. I don't want everybody pulling all of your deposits out. But on March 10th and on March 12th, we had the number 2 and the number 3 biggest bank failures in the United States history. And that sounds like a lot, and it is a lot. This is a big deal. And I'll get into a little bit of the detail on what happened. And I apologize. I do want to get a little into the weeds on this one because it's a new topic, and it's something that we probably will see, flying through the headlines for the next potentially couple months. So this is where I get a little into the weeds, and I apologize if people's eyes glaze over. But ultimately, think of it almost like a risk diagram of many of the banks within the United States. And the way to look at it would be the x-axis, so going left to right. That is the losses of as interest rates hike and banks are taking their deposits or their capital, basically their regulatory capital, and they're investing that into things like treasuries. The x-axis represents what percentage of that regulatory capital is experiencing losses. The y-axis, which is looking at the level of deposits that are in excess of $250,000. Now, many of you on this call may be saying, I don't have anywhere near $250,000 at the bank. And I would say that probably makes sense. You probably shouldn't have too much of your money sitting at a bank because it really isn't earning you a whole lot of money. So just having cash sitting at a bank in excess of 250 grand isn't keeping you up with inflation. But the other thing that it does, if you're above $250,000 in deposits at a single bank, that money in excess of 250 grand is not insured by the FDIC. That's the Federal Deposit Insurance Corporation. If you didn't understand any of what I just said, think of it this way. The further you get into the top right corner of this chart, the more losses you have on your investments and the more deposits you have that are in excess of that insurance threshold. Or in other words, these are uninsured deposits and the bank is losing money is basically the way to think about it. Perhaps no coincidence as we look up in the very top right corner, that SIVB, that's Silicon Valley Bank. That is one of the two banks that failed, and they failed in a very quick fashion. The other one, which is highlighted up in the top middle, that's Signature Bank. So that bank is actually going to be out of New York City. Obviously, as we can see on this diagram, it kind of makes sense. Both of those institutions had one thing very much so in common, which is a lot of their deposits were in excess of $250,000. So what happened? You literally had a situation where there were, a number of very wealthy depositors, either individuals or corporations, who had their money sitting at these two banks. And my guess is they took a step back and they said, there are some headwinds in the economy. I've got a lot of cash that's uninsured and sitting at this bank. Why would I do that? If I need to have money sitting in a bank account, why don't I reduce it out of Silicon Valley Bank, Signature Bank, and distribute it across a bunch of different banks to get it back down into an insured level? And that's what happened. And unfortunately, and we don't see this often, but it can happen in a very quick way. And the way banks are set up, when that does occur, it makes it so that the profitability of these operations can tailspin fairly quickly. And we saw that in a matter of a couple of days, both of these banks failed. Additionally, we ended up seeing Credit Suisse out of Europe, they failed. And then as we look here in this chart, in kind of the middle upper section, FRC, that's going to be First Republic Bank. And they're currently in the headlines very heavily right now because they too have a situation where they've had a fleeing of deposits, and perhaps to no real fault of theirs. It's just they had a lot of wealthy accounts sitting at their banks. Well, they realized that they weren't really insured, they weren't protected on those funds, and they decided to diversify their money across this. So that's really the crux of what's happened, is interest rates moving up very, very rapidly, and then people having a lot of money well beyond what the FDIC insurance limit was. And they said, we need to figure out this risk. We need to take it elsewhere. Well, and I guess the other thing I would say is those two banks would be considered more on the regional side as we think about some of the bigger, quote, too big to fail banks, JP Morgan, Wells Fargo, Bank of America, your bigger kind of household names. You may think, oh, well, those banks aren't at risk of these same things because they're bigger and they can't fail. Well, I would actually argue that they're probably seeing some of the same things as well, maybe not to the same degree, but what, I guess what I want to do is I want to revert back to this chart, which is showing interest rates have gone from 0% to 5% in the last year. So hypothetically, you could think to yourself, well, why am I not receiving 5% at the bank? But, if interest rates have gone up from 0 to 5%, why are you not getting 5% on your deposits? I looked before I hopped on the Cup of Joe. JP Morgan, for example, and don't get me wrong, great bank, they pay 0.1% on their deposits. And that's despite the fact that interest rates have gone up by 5%. So I do think you have a function of people saying, well, why in the world would I hold my money at a place where I'm getting 0.1% when I could go out and I can buy short-term treasuries and I could get 4%, 4.5%, and actually keep up with inflation a little bit? And what this chart is ultimately showing is basically that. With the white line is going to be US commercial bank deposits. And this is all over the last year. So this is basically since the Fed began hiking interest rates. That's going to be on the left axis. So it's gone from, let's call it $18 trillion down to about $17.5 trillion. And that's trillion with a T. So even though it may not look like a big amount or a big drop, that's $500 billion that has moved out of the banking sector. And that's not just regional banks, that's big banks, small banks, all of them. The blue line is that's showing the level of assets at money market funds. So a money market fund is basically a mutual fund that typically invests in things like short-term treasuries, very, very high quality, short duration, but now decently high yielding treasury securities. So what you're seeing is people taking money, not just out of regional banks, but taking money, if they have a little excess cash, a lot of people are saying, why don't I take this and move it into a money market mutual fund where I can get 4.5%, actually help to fight inflation a little bit. And you can see the blue line has basically been a mirror image of bank deposits. And that's completely a function of people wanting to, one, diversify away their risks. So if they were above the FDIC insurance level, they want to split that money across more banks. And then the other thing is there's a hunt for yield. And the hunt for yield is looking for things like treasury bonds, treasury bills, and money market accounts. And that's really what this chart is showing, is really no bank is safe unless they're willing to offer a competitive rate and a competitive yield on your money. So I know I rambled on quite a bit, but I did want to make sure I touched on that. It is worth noting that in the next week or two, we're going to start to get some of the Q1 bank earnings. And there's going to be a lot of fine-tooth comb going through all their financials to make sure that they're safe, that not too many deposits have fled, that they can still operate. And there are going to be winners and losers here. There's no doubt about it. But that's kind of how the banking system as I'm viewing it right now. And unfortunately, we've had a couple failures and they were extremely quick. And there will probably be some knock-on impact from this, because what I really want to hone in on is, you're probably hearing all this saying, that's all well and good, Nick, but what does that mean for me? What does that mean for the manufacturing sector? Well, this is really where that's summarized. The left-hand side is showing, and this is going all the way back to 2000, it's showing the percentage of businesses witnessing tighter lending standards. So that would be things like, higher rates or more difficulty to get a loan. And then the right-hand side is showing percentages of businesses witnessing stronger demand for loans. And you can see the two charts are really going the opposite direction. And what it ultimately summarizes into is credit conditions, lending, the ability to get money, said another way, is getting more difficult. And I would suspect that as we go into the second half of this year, these situations are likely going to feed through into the economy, because make no mistake about it, the credit system of the United States and the banking system, loans and credit are the lifeblood of an economy. And I'm not saying that they're going to cease to exist, but they're certainly going to be more expensive. There's no doubt that banks are looking at every one of their portfolio companies and the individuals they lend to, and they're just having a slightly higher level of scrutiny around those lending practices. It's probably worth noting, and we've talked about kind of the revenge of the old economy in prior Cup of Joes. There were 64,000 startups that banked with Silicon Valley Bank. Their name kind of says it, Silicon Valley Bank. They operate in the West Coast, mostly with startup type entities. I would expect the pain to be a little more painful within that side of the world than our traditional manufacturing companies. But I think across the board, this situation where you have bank failures, it's going to make all banking executives take a step back and say, we probably should be a little more conservative, be a little more prudent with our money, and we may even see some additional regulations as we roll through the next few months.
Nick, just so I'm reading this right, demand is going down because it's tightening, right? Because it's tight. It's not that less are in need of these loans. It's just that the demand is waning because they just can't get it. Am I reading that correctly?
Can't get it. And even for those who can, the interest rate's gone from 0 to 5%. So if that's related to a mortgage, there could be a lot of people who are moving off, or moving back to the sidelines because of the rate to finance a car or finance a house has gotten a whole lot more expensive.
One question: Have you seen the price of gold spike at all throughout this?
Yeah, there has been. So there's been a little bit of a weakness in the U.S. dollar, and there's been certainly a risk-off move into gold. Gold tends to be kind of a flight to quality type asset, and there certainly has been both in gold and silver in the last couple months.
Yeah, interesting.
Yeah. So we're left with this scenario that Jay Powell is kind of sitting here at kind of the fork in the road, thinking, one, do I take the path of continue hiking interest rates at the risk of potentially blowing up more banks, potentially bankrupting more startups, causing more economic weakness? Because that part of that would be the intent of bringing inflation down. So that's why you would continue hiking, but there are definitely going to be some externalities with doing that. The other alternative is you ease rates, you actually begin taking interest rates back down. The issue with doing that with inflation still at 5 or 6% is you didn't really accomplish your goal. And if you start to ease, do we see oil go back to 100 or God forbid 120, 130 or something like that? Inflation really start to perk back up, and then they have to go back to the drawing board and figure out how they're going to fight that. For now, the odds best bet is they're going to pause. And by pausing, it simply just means they're not going to hike, they're not going to ease. They're basically going to take a straight line through that grassy area in the middle of the two, and then just watch the data. That's what it looks like they're going to be doing for the coming weeks and months, is every single CPI data point that comes out regarding inflation, every data point regarding employment. They're going to be watching these with a fine-tooth comb, and every single one of these that comes out is going to change their outlook on whether they want to remain hawkish and keep tamping down the economy, or if things continue to break, financial system needs some help, maybe they start to ease. Unfortunately, in my opinion, if they do go the route of easing, it probably won't be because things are going well. In my opinion, if they start to ease, it's because they have to, and things are getting a little tricky. So for now, it looks like for the next couple meetings, the expectation is they're going to pause, they're going to watch the market, they're going to see how data comes in. Because don't get me wrong, some of these things are going in the right direction, as I mentioned. Inflation is coming down. Employment is getting a little trickier. We oftentimes talk about job openings. Job openings are there's still a lot of them, but they peaked out around 12 million people. They're down at 9, I think it's 9.5 right now. That's still about 1.3 jobs that are available for every person looking for one, but it's going in the direction that the Fed wants, which is to cool down the economy. So with that, I'm going to kick it over to Jeff Penz. Some of you know Jeff, perhaps from the last time he was on Cup of Joe. Jeff covers the international markets for Ryerson, so our importing strategies. He also covers the scrap and secondary markets for Ryerson. So I'm going to kick it over, Jeff. Take it from here.
All right. Well, thank you. And thanks for the return invite. So we'll see if we can do this again. I'm going to mainly focus on the carbon market. I will touch a little bit on aluminum because there's some new developments on the import front. But one of the things that I'm going to take us through a bunch of factors that we've kind of considered and more or less try and paint a picture of what's happened over the past year and how did we get to where we are and kind of where things are looking like they're going. And part of understanding import is understanding the domestic option that you have at the same time. So I'm going to bounce back and forth a little bit between both, but factors to consider are lead times, domestic mill utilization rates, scrap, geopolitical economic environment, which is a long way of saying government, ocean freight, futures market, and price. So I'm going to jump into each of those ones and talk a little bit more. So throughout 2022, what we saw was the domestic mills, their lead times started getting shorter and shorter. And in a typical market, lead times for hot rolled, they're about a month, about 4 weeks. We saw that even shorter than that during 2022. Domestic lead times currently are sitting at just over 2 months. So they're really stretching the bounds. Now, that is important because by comparison, foreign mills are about 4 to 5 months from when you place an order. So if you're thinking about that in terms of your own consumer, going and shopping, you're going to be buying something today. You're going to lock in a price today that you're going to get 5 months from now. So you really have to be sure, is that going to be a good deal by the time it arrives? Moving on to the next thing that we consider is the mill's utilization rate. And the utilization rate is really a measure of their capability to produce against what they're actually putting out the door. So during the peak of the pandemic, some mills were running as high as 90%. That is considered about as good as a mill can do. Now, all of the distributors, and I say all, I'm generalizing here, but most distributors in 2022, they kind of saw this declining market, lead times getting shorter, prices coming down. There was this expectation that Q1 of 23 wasn't going to be as robust as what we had seen previously. So a lot of distributors took their order book down and committed less tons to the domestic mills. Now, why is that important? Because right now they're running at 75% of capacity. So the mills have the ability to ratchet up and increase supply, but they're more or less affecting supply by running at a lower capacity. So, more tons at a higher price is good business than, less tons at a higher price than more tons at a lower price. So that's something that's, yeah.
Yeah, Jeff, just to interrupt you there, I guess a question for you. Pre-COVID and maybe a couple of years prior to that, the United States would have had, let's say, 8 to 10 big primary steel mill, at least steel mill brands. Now we're sitting maybe four to six.
Right.
That oligopoly or that concentration of the supply side, not to make an OPEC reference, but certainly there is a power shift that's been given to that smaller grouping by way of acquisition. Do you think that that's kind of the new normal, that they're just going to kind of flex their muscles and when they need to tighten things up from a supply side? And
I would love to think that, but the old analogy that your chain is only strong as its weakest link. As long as you have one player that's willing to move the needle and take an order, that is sort of the spark that lights the either the uptick or the downtick in a market. And I will say, from a discipline standpoint, from my perspective, they're much more disciplined now than we've seen ever in the past. And I think that having less players is a major factor that contributes to that.
Yeah, fair.
So scrap, Nick mentioned one of the things I also look after is scrap for the company and recycling. So what I wanted to just show was this picture, and these are the Chicago busheling, heavy melt, and shredded numbers that are published in the AMM each month. And I went back to 2020. And what's interesting here is that if you look at the numbers, we sort of peaked in March and April of 22. And then from March and April of 22 through December, it was pretty much this decline in scrap pricing. Now, why is that important? Well, the next point there, Nick, the majority of the mills in the US are EAFs, electric arc furnaces, and they're fed by busheling scrap. So the product that they're making, scrap is a major factor. It's a major component of the finished price of those goods. If scrap was falling, lead times were coming down, everyone looks into their crystal ball and says, hey, what do we think next year is going to be? No one wanted to go long. No one wanted to take a position and say, this is going to just turn around and get really good. So it kind of explains why we're in the situation we're in today. And it's just, scrap is such a major component. It's the largest cost, I guess, next to energy of producing new steel. Continuing on with scrap, one of the things that we look at, and headlines are great, they can tell you a story or you have to interpret them yourselves, but Turkey is a major buyer of US scrap, and they buy export scrap via ocean deep sea vessels. And these are some of the headlines that have come up just in the past week. Turkish steelmakers resume deep sea purchases at much lower prices. The second one is interesting because Turkish scrapping, the demand is under pressure from increasing local supply. Now you might say, okay, so what changed? Well, the earthquake is what changed. One of the interesting things when there is a natural disaster is it usually sparks rebuilding and growth, and it almost acts as a bit of a stimulus. When you look at Turkey, there's actually a huge component now of local scrap that's being produced because of all the rebar and everything else that's in the rubble that's being pulled out. So they've had less demand to go to the US to buy scrap. So that's putting downward pressure on scrap pricing. And as you can see, the pricing, there's some fatigue in the market there as a result of that. Global scrap market's down on bearish sentiment and weak steel demand. So these are all things that are contributing to, the prices and the future out. All right, and so geopolitical, just like I said, a fancy way of saying government involvement. So when you're buying import, you have to think about things like tariffs and duties. A lot of people on the call will be familiar with Section 232. This was enacted as a threat to national security. This started out with a 10% tariff on aluminum, 25% on stainless and carbon. A lot of countries have migrated to this TRQ, which is a tariff rate quota. And essentially what the government did is they said, okay, we're going to look at a historic level of imports. We're going to allow you to bring in a historic amount without a tariff on it. Anything above and beyond that will be subject to the 10% and the 25%. Then there's Section 301, which was really targeted at China for intellectual property, which adds another 7.5% to 15% to 25%, depending on the item. Then you get into anti-dumping. That's when a foreign country sells material into your country cheaper than they sell it in their home market. Then there's countervailing duties. These are subsidies the foreign mill receives from the government or is allowed to produce that are an unfair advantage. These are things that you have to take into account when you're bringing in import material, because depending on what country it is, what mill it is, there are just a vast array of different amounts and duties and tariffs that apply in different situations. Now, this is where I'm going to touch on aluminum. Bringing material into the US, you have to declare it in the ACE portal, which is the automated commercial environment. On April the 1st, any aluminum coming in from Russia is now subject to a 200% additional fee. I mean, that's absolutely huge. I mean, that has completely shut the door. But what's really interesting about that is the government has taken it a step further through this ACE portal, where you actually now have to declare the country of smelt, your largest smelt and second largest smelt. So if a company in a country that's allowed to bring material into the US was buying Russian aluminum before April the 10th, they would have been able to buy ingot from Russia, melted in their own country. It becomes product of that new country, and they could bring it in. Now, if it says Russian smelt, even if it's secondary amount, if there's just a trace element, that'll be 200% duty on that, on top of what you paid. So take whatever
Jeff,
number you are. Yeah.
So Jeff, question for you on that. I assume we've got a lot of buyers of finished product. Maybe they're not buying ingots, but they're buying finished product. They don't know maybe, or they don't care where the ingot is produced, or they haven't historically thought about where the ingot is produced. Right. Who would you recommend they go to even get clarity on something like that? Or what would you say is the process you would recommend somebody who just wants to investigate if they've got issues? They've got, they might be standing on a landmine that's coming to the United States right now. How would you recommend that process?
So that's an interesting question, because it's really going to depend on what it is. And finished goods are much different than what we're bringing in, because we're bringing in material to be made into finished goods. So there are different classifications, and each one is determined by the HS code or harmonized tariff code that's used to clear that into entry. So my recommendation, if you want to look it up, is to go to Google, type in the product that you're bringing in. That'll bring you to a US trade website for CBP. You can type in the type of product that you have. It'll show you a list of various HS codes that can apply to it. You have to really read through, because things like, I'll give you an example, the width of the material can affect it, the thickness of the material, the chemical composition can affect it. So you have to really narrow it down to which bucket does this apply to? And I know it's a bit of a vague answer, but it's really, there are so many possibilities. You have to look at it at an item by item basis. But the government, the CBP website is a very good resource for doing that.
And also
So,
some riveting bedtime stories in there, I'm sure too.
Absolutely, absolutely. So, and then just for good measure, they threw an extra 70% on most unwrought and semi-finished goods out of Russia. So you're looking at 270% that all is taking effect. We're April the 6th today. So in 4 days, the new 200% on primary and the 70% already went into effect on April 1st. So it's a lot of things going on, a lot of things to take into account when you're factoring in import.
Yeah, question from the audience, Jeff, and possibly even Nick. Have aluminum prices reacted to the Russian tariffs at all?
I would say they've already reacted to the Russian tariffs, because if you think back when the war broke out in 22, the government basically said, we don't want aluminum coming in from Russia. At that time, I think I remember seeing a statistic that Russia had something like 13%, and Nick could probably correct me on that, but 13% of the world's aluminum supply. Most of that is down to very little now. I mean, anyone who was using Russian aluminum in the United States basically has got away from that. So I feel like that's already built in. What it's probably going to do more than anything is catch some people that aren't aware of where their material's really coming from.
Yeah, and Jeff, correct me if I'm wrong. The ACE portal and these applicable tariffs, those are just for the United States, or is this?
Correct. Each country has their own, but that's for goods coming into the United States. So whether they went into Canada first, went into Mexico, and came up, the moment they cross the border into the United States, the government's looking at that. So it's not like you could say, hey, I'll send it over here and then it'll be fine. The moment it crosses the border, it's getting hit.
The reason why I wanted to point that out is just because, and it may take time to reroute supply chains, but there are going to be nations who still want aluminum. And if it's Russian and they're not in the United States, so be it, they'll probably still buy it. So that would likely make a more muted impact. Now, it's going to impact things in the United States, and perhaps in the short term, it's going to impact Russia's ability to export and sell aluminum in the short term. But my gut would say there will be nations who will step up and say, well, one man's trash is another man's trash.
It's funny you say that, because one of your comments earlier was about Russia's GDP increasing and things like that. And we sit here saying, how is that possible? We're buying less and less all the time. Well, countries like India and Pakistan are buying oil, and they're buying aluminum, and they're buying other things. And I don't mean to pick on those two countries, but there are countries out there that say, hey, just because it's bad for the US doesn't mean it's bad for me. And some people may kick that moral argument to the side and go with the pricing. So that does happen, absolutely. And then ocean freight, I guess the last time we talked, there was nothing but lineups of ships. You couldn't get containers, prices were out to lunch, and everything's better now. Well, yes and no. So now that we have less ships, less transportation, you're waiting a bit longer. The price has come down, but you can't always get the container that you want. 45 footers are still in very short supply. And, it's just waiting for that ship. If there's less vessels, you can't always be releasing them when you want to. So your goods are sitting on the dock a little bit longer, or they're going on a feeder vessel trying to get to where they need to go just to build that load. Then over to, oh, sorry, if I could add one more comment there. Exactly, that was the more transloading and handling is involved. So the futures market, this one here, there's the crystal ball in the bottom corner. For anyone who doesn't know, a future is a derivative financial contract that obligate parties to buy and sell an asset at a predetermined future date and price. So in English, they really allow you to buy something at a future value, but they provide a window into what we think is going to happen. Now, if we look at hot rolled coil futures by month, you can see right now, we're very close to what is considered the peak. And this is based on what people are willing to buy and what people are willing to sell on this calendar. So remember at the beginning, I said you're probably going to wait 5 months from when you place a purchase order for that material to come in. If you move down the scale 5 months, it's a pretty good indication that that might not be worth what it is today. Now, the one thing I can guarantee about this chart is it's wrong because it won't line up like this exactly when we overlay reality with what the future is, but it's a very good indicator on what is expected to happen. You know, it's directionally valid, as they say. So let's take a look at pricing over the past year. We can see, you know, hot rolled prices were, you know, up to $1,493. Since then, they've come down $340 off of that, but they're up $535 from the low in December of 22. Again, we saw that curve where pricing just continued to drop on the scrap chart, and more or less the products all followed suit. And this compares with, you know, the price of hot rolled in China. Now, the Chinese price, it doesn't have freight or duty or tariff or transportation or all of that. But, you know, this is where you have to really start evaluating what is my price today based on when I can get it, what is my price from import based on when I can get it, and what are all those factors of cost that are going to go into that to make the decision. So once you've done all of that, you know, you've looked at it, compared your import offers, looked at the ETAs, factored in futures, scrap it, market utilization, shipping costs, geopolitical. And this is for all the people, I guess, under 40 on the call who can Google this afterwards. I said, in the infamous words of Harry Callahan, do you feel lucky? And well, do you? And that's a little bit of what import is like right now, trying to figure out where we are in the cycle and where it will be by the time it comes in.
I think the version of this quote that I know better is from Jim Carrey's The Mask. I don't know if you know that.
That's a few years after
Absolutely. Well, you got a few years on me, Jeff.
Yes.
But hey, really appreciate everything here, and we'll have you stick around just in case there's any Q&A through the balance. I know we're getting a little tight on time, but it's because we got a lot of content to cover. Do want to cover the aluminum markets, the stainless markets here in the next few minutes, and then we'll open it up for Q&A. Not to beat a dead horse on the carbon side, but this is just a visualization of what Jeff was talking about. This is looking at the capacity utilization for U.S. steel production. And you can see right now it's just a touch under 75%, which probably means, I would say, I read this as mills are still being pretty responsible and constrained with regards to the amount of production they're putting out in the market. So even though we don't have a gangbusters demand side of the equation, it's okay. The reason why prices have gone up the way they have over the last few months is because the supply side has been pretty well constrained, while also imports have been on the decline for the better part of 9 to 12 months. And then, again, not to belabor the point, I found this fairly interesting. If you look at the blue line, which is the futures curve as of 6 months ago, and you compare that to the orange line, which is futures as of this week, the front end, or said a different way, the left side of the futures curve has gone up by, let's say, $450 per short ton. What's interesting, or what kind of shocked me, was the back end of the futures curve. So basically everything December of 2023 and on is actually lower than where the price would have been 6 months ago when the spot price was, say, $500 lower. So very interesting market dynamics where we've had this massive run up in the price of hot roll coil and really all sheet over the last couple months, but yet the longer term expectations are a bit more incrementally bearish. I would say that that's mainly attributed to the fact that these banking issues, the Fed hiking further than what many thought we were going to hike, are likely just increasing the headwinds or the concerns of what may be coming in the back half of the year, perhaps into the early 2024 months. But flipping over to aluminum, this kind of tells the story that Jeff Penz was touching on, which is a lot of the impact of these tariffs and protectionism around Russia. They really kind of already took effect, and you can see that even though prices have come off massively in the last 12 months, on a historical basis, $1.06, which is where we basically are on a spot basis, that's still a pretty elevated number. I drew in this trend line, and you'll see the same thing in the price of nickel, where, yeah, prices have been beaten up. I've also got the moving average lines. So that's a 50-day, 100-day, and 200-day moving average lines. Those are good gauges of momentum. Right now, we're kind of in the thick of all of those moving averages. So we don't really have a whole lot of clarity on where the aluminum market wants to go. But you can see that when we look at that white trend line, prices are still holding up okay for right now. I think all eyes really are looking to China to see if they're going to launch a bigger stimulus in Q2 or perhaps into second half. If that happens, I would expect this upward momentum to continue. If we continue to see banking issues, lending issues here in the United States, I would expect the opposite. So those are really the two key themes I would say we need to keep an eye on as we look forward to the couple months. That being said, when we look at fundamentals of aluminum, and this is coming from Goldman Sachs, they have revised their expectation of the deficits lower, or said a different way, they are less bullish on aluminum, given the fact that you've got a slightly weaker China than previously expected, and you have the banking woes here in the United States. But even despite that, their latest forecasts, which are shown on the left-hand side in dark blue, it's still forecasting multiple years into the future of aluminum deficits. So those are in 1,000 metric tons, or 1,000 kilotons, rather, on the left-hand side. On the right-hand side, you can kind of see the adjustments that they made to their deficits, or their deficit forecasts, rather, where they've got a little incrementally less demand being forecasted out of China, a little more supply coming out of China. But despite all of that, the red line is showing you their new forecast for 2023, which is a fairly sizable deficit. So there are a number of banks from a fundamental standpoint who are still viewing this market as pretty tight. I think Goldman would also echo that that's the case within copper as well. Nickel, stainless, I would say, is a slightly different story. Even though the chart looks kind of the same when we draw in that long-term trend line, which is the white line, we are for now still sitting above that. From a moving average standpoint, we're a little lower relative to the moving averages. So for now, I would say the momentum is still a little bearish right now. The fundamental situation within nickel is a little different than aluminum and copper, I would argue, insofar as there's a lot of new supply coming online. And we've talked about this in prior couple of Joes, but there's a lot of new supply, mostly secondary type nickel units, nickel pig iron, nickel matte, that's coming out of Indonesia. We've also touched on the idea that because visible inventories of class 1 nickel are a little tighter than this growing supply of class 2 nickel, we are seeing some buyers of nickel and stainless opting to go towards the cheaper routes, which would be leaning more on class 2 nickel. And you can see that really depicted in the left chart, which is just showing that on a year-over-year basis, there is a little bit of a swapping out of class 1 units and likely going to something that's much cheaper, which would be class 2 units. And then what that's amounting to is over on the right-hand side, which is showing multiple years into the future of forecasted, not deficits, but actually surpluses of class 1 nickel into the future. So all things being equal, it does look like the nickel market is going to be well supplied, even in the face of a burgeoning and growing electric vehicle market, which is pretty fascinating. Kind of gives you an idea of how large these supply side expansions are, again, mostly out of Indonesia. And then lastly, it's another month, it's another issue with reforming the nickel market. Just in the last week or two, the London Metal Exchange came out with additional color suggesting that they're going to try and further improve the way their nickel contract works by allowing a new grade or a new form of nickel to be delivered on the exchange. We talked last month about the idea that there was a fraud regarding, I think it was like $500 million worth of nickel that turned out to be rocks. LME's having all these issues. They've also got this glaring issue of the contract that is represented on the London Metal Exchange is a class 1 market. As we noted though, the nickel market is very, very quickly growing into something that looks a lot more like class 2 nickel. So what that means is the nickel contract on the LME isn't really a great representation of the worldwide nickel market. So what they're doing is they're going to add, in addition to like briquettes and pellets and things like that, they're going to add the ability to put powdered form of nickel on the exchange. That's the current reform. It's all in an effort to try and get the contract a little more close to reality. So again, just more reform coming from the London Metal Exchange. It's still a bit of a mess, but I think the big overarching takeaway on the nickel and stainless side is it does look like it's well supplied at the moment. And then this is just a quick aside. Price of chrome on a quarter over quarter basis expected to be up about 15% quarter over quarter. So that'll take surcharges a little higher. That's mostly due to power issues in South Africa. And then conversely, it looks like the issues that we saw with regards to 316 stainless and molybdenum prices, which went absolutely crazy. They basically doubled in a couple months. Those are now coming back down to earth. And we've seen, I'd say about 25 to 30% declines in molybdenum prices in the last 30 to 45 days. So a little bit of a reprieve there if you are a buyer of 316 stainless. But with that said, I know we took a lot of territory, we took a lot of time, but with the help of Jeff, I think we covered a lot of really good information, and that's what we got.
Yeah, this has been power packed, a lot of good information. Jeff, thank you so much. Nick, great analysis on the banks. I think that chart where the X, Y axis really kind of puts it into perspective, right? When you look at, why these banks, quote unquote, failed, right? If you kind of look at that outlier up in the far upper right, you can kind of see it's a nice depiction of what kind of is behind that. So jam-packed information here. I want to squeeze in two questions. One actually just came in when you talked about the class 2 nickel. Is that interchangeable with class 1 nickel as far as applications are concerned?
Sort of. For the production of stainless steel, class 2 nickel can be utilized. Even in some cases, I believe nickel matte can even be utilized for the production of electric vehicle batteries. It's not perfect, but yeah, in many cases it can be substituted. One of the biggest offsets, or one of the biggest hurdles, is if you're utilizing class 2 nickel, it tends to be more pollutive. So to the extent you're in a nation or region that's more concerned about ESG and polluting factors, those, you may not be able to rely as heavily on the class 2 units. But I will, over in Asia, they don't really have quite the concern that I would say the Western world does at the moment. So they're leaning very heavily on that space to make their stainless.
And the powder that you mentioned, is that kind of from an additive perspective, or is it?
No, it's literally just a different form. It would be just, I guess it would be what could be utilized in additive manufacturing, but yeah, really it's just another form of the product that it just allows more supply, more applicable supply to be deliverable on the exchange.
Okay. Question from the audience, back to aluminum. What trend do you see for the Midwest premium right now?
In the last couple of weeks, months, we've seen a bit of pressure. So it's been choppy. We went from about 20 cents 5-6 months ago to 30 cents. We're seeing that fade back down into the mid 20s. I tend to be of the opinion somewhere in the 20 to 25 cent range is likely where we settle probably for the balance of the year, until or unless any logistical issues happen, which all things being equal, I'd say the logistical networks are loosening up a little bit versus tightening. So yeah, if I was a betting man, I'd say we probably creep back down towards 20 cents from 25 right now.
Yep. Jeff, this one's for you. Is anything happening with the West Coast dockers workers contract? I guess, and last time we talked at imports, one of the big hurdles was the dock work, the workers, right? Shortage there, some issues. Is anything going on like that right now?
Well, I do know that there's the group, from what I understand, there's 22,000 members of that workforce that are affected, and I believe just last week there was a coalition that reached out to Biden, lobbying him to get involved and get this thing resolved. So that was made up of, I think it was state and local trade representation. So there is pressure to get something resolved there, because as far as I understand, they're still without a formal contract at this point.
Yeah. And I guess a question I have for you is that we touched on this last episode, and with regards to imports, the annualized tons coming in really dropped. I think Nick, we said from like 12 to about 7 million tons. Do you, and kind of with all these factors converging to, the what's going on here domestically with carbon, do you foresee possibly imports rising up again or spiking up?
Well, anytime you have a run up in price like you've had with the domestics, you're going to open the door for import. And typically what happens is when that door is opened and those start to arrive, you see the decline in price on the domestic front. So it's a cycle, and we're in the cycle right now. Yep.
Like I said, a lot of jam-packed information here. We've run over, but I think with good. I mean, we've covered a lot of great ground here. So Jeff, why don't you give us a final word and then kick it over to our good buddy over there with his cowboy hat.
Well, I just thank you again for having me. I mean, it's a pleasure to take part in this, and I always like tuning in to hear what Dr. Doom has to say. So
thanks for the opportunity. Attending. Love it.
Thank you again, everybody. And again, I know we ran a few minutes over, but I really do think this is important stuff. And I promise there will be a time where there won't be enough to talk about that we fill an hour. But I know the Dr. Doom reference was made. I don't want to fear monger too much, but I do want to definitely instill a little element of caution. I do think that, if things were running really well 3 months ago, they're running well, and there are definitely efforts to try and cool this economy further, even from here. So I think there are definitely some headwinds as we look into Q2 and second half, but it doesn't have to mean sky is falling. So the Dr. Doom is fully a joke, but I do think there are some headwinds that probably keep us a bit cautious going into the balance of the year. And we look forward to talking about all the topics, and y'all be well.
I used to like to call them risky business. That was I think it's a little idiom there. Thanks all.
Hey,
See you next month,
Bye.
May 4th.